This is Matt Godleski with Stewardship Financial Advisors Investment Committee, bringing you this week's snapshot edition of The Pulse. Here's what we're watching this week. Stocks drift downward with election uncertainty creeping in as a final push for a fiscal stimulus deal in Washington is made and earnings season continues. Markets trended negatively this week as all eyes remain glued to stimulus talks in Washington and developments in COVID spread and vaccine progress. The Democratic-held House and Republican White House continue negotiating a fresh round of economic aid, as time is running out for desperate households and businesses who remain impacted from the effects of COVID's shutdown, job losses, and social distancing policies. Meanwhile, approximately a quarter of the S&P 500 companies have reported their third-quarter earnings, showing mostly negative growth rates, though more than 80% have exceeded already low expectations. In a positive sign for workers, initial jobless claims fell to the lowest number since the pandemic began, and continuing claims are also moving lower, though remain above 8 million. Investors are becoming increasingly cautious leading into the election, now less than 2 weeks away. Hedging for the potential outcomes are at extreme levels, as stark differences are seen between the potential election consequences. Bets can be seen across all asset classes, from treasuries to equity sector bets to option markets, and lessons from the 2016 election remind everyone that polls can be nearly meaningless in the weeks leading up to the vote. This leaves asset managers in a precarious position: hide out in cash or make risky bets on a potential winner. Current positioning recommends the following would benefit from a blue wave: cyclicals, value stocks, international equities, infrastructure investments, and corporate credit. Meanwhile, a divided Congress or Trump re-election would likely benefit treasuries, technology, healthcare, growth, and energy stocks. As policy outcomes from either party vary so starkly, it is nearly impossible to trade with high conviction at this juncture given the close race. Add to that the complete unknown direction of COVID and a potential vaccine, with many trials coming to an end in coming weeks, and you have a recipe for volatility with either surprise upside or downside ahead. At this time, we are continuing to reduce our equity exposure and add liquidity to be prepared for volatility ahead leading into the election. Caution reigns supreme in portfolios as the potential outcomes vary wildly. We have positioned equity exposure to benefit from long-term secular trends in technology and healthcare, while also looking to take advantage of tactical winners from a near-term change in market leadership. Within fixed income, we have trimmed the allocation to treasury bonds, which provide little marginal benefit in terms of downside protection due to low yields, and we've increased our exposure to corporate and high-yield bonds, which present a relative value in today's market in our view. Perhaps most importantly, we believe that any near-term pullback from the election will present a buying opportunity, as either party's win will ultimately result in additional stimulus, boosting risk appetite in the coming 12 months. However, the distinct sectors and industries that will be beneficiaries of said stimulus lend to an active approach in security selection in this tumultuous time. Thanks for watching, and check out our website to read the full version of The Pulse for more details.